Paul, I got a bone to pick with some people here. We're talking about Alibaba. On this show, folks, for 3 years, we sat here and told you not to buy in this overpriced market. When Tesla was $700 prior to the split 3 years ago, Paul was saying it's overpriced. Now it's like $4,000. So we keep saying everything's overpriced. Don't buy, don't buy. Every comment is these three morons don't buy anything. Then all of a sudden we say, we like Baba's numbers. And damn it, we're buying it. Charlie Munger is doubling down on his Baba shares, and we will get into that. But it's hilarious, Paul, that
and what I always say,
myself, I could not grasp the idea that if I like a stock and I'm buying it and it goes down, you should be happy about this.
If you want to buy more shares, yes.
If you want to buy more shares and work toward a full position.
Correct.
So can you please re-explain to me, the imbecile that is trying to host a show, and our viewers out there, how excited. This morning you walked in here, learned that Alibaba was up, and you screamed obscenities. That's how upset you are that the stock is currently going up. So let's gather ourselves, folks. Not every time you buy a stock, Baba, Apple, etc., will it immediately start going up the next day. If you can't grasp this, like I have trouble with sometimes, Paul will help you. Go ahead, Paul.
What's going on, Mo? What happened? First off, follow us on Instagram. You can see me rant and rave about my dogs.
And before you get rolling, nowhere in what Seth just said or what we've said in previous videos said for you to go buy Alibaba. We just said that we liked it. We do not make stock pick recommendations to say you go buy it. So if you bought it, that is on you.
Thank you, Mo.
Well, and guess what? If you have the right process, if you have the right mindset, you should like that Baba's falling. So one of our mutual friends, one of Seth's best friends from college, messaged me the other day and messaged Seth the same thing. Paul, I get it. If the stock falls, we want it to fall, but when do we want it to go back up? Selfishly, when I get my full position in. When I've gotten 3 or 4% of my holdings in that stock, that's when I want to go up. Now, what happened here that the stock's up 9% today? Does anybody know?
No, I don't know. I'll look for you, but I don't know what the news of the day is on it.
So Seth brought up Charlie Munger. Charlie Munger is Warren Buffett's business partner. I don't like to mimic other investors in the sense of
Manesh Pabrai's cloning philosophy.
More power to him. But for me, I like to do my own analysis. But what I will say about Munger that I did copy, I was always apprehensive. Look at other past videos of Baba. I was always apprehensive about the numbers coming out of Alibaba.
Oh, this stock, Paul, when we first analyzed this at $300, this was a laughable, I'm not touching this. This is crazy. Yes. No way I would trust anything.
But then it falls in half, and all of a sudden I go, wait a second, I like this. And then when Charlie Munger buys it, to me it says he has a lot of dealings in China. For me, it says he trusts those numbers.
So what we're talking about is Charlie in his 13F filing, which he files early, Paul, not like some other companies. He did double down on this.
82% increase in his position in September.
Realistically doubling down.
He bought it at 148. His new position was at a cost basis of 148 a share. I don't know why. I mean, is it because of, do you have?
It's because it's just less improved risk in Asia. That's really what it comes down to.
So
there's no specific thing. It just says improved risk.
I mean, listen, anything can happen. If the market goes down, this will probably go down with it. But I bought the first, my basis right now is 174 on my shares, and I wanted to get a lower basis. I have puts for next Friday at 150, which I thought for sure I was going to get. And now it's not. Now if the stock stays here, I'm not going to get those shares. I sold more puts yesterday at 135. I'm trying to build my position.
So what is the mindset we should have, or someone at home who is writing in the comments below, damn it, Paul, you told me to buy this at 200 and now it's down. I hate everything money.
Nobody said to buy it.
So Mo's getting a little frustrated. It's not, don't worry about it, Mo. What it is we're just telling you how we're investing. If you want to mimic us, I can't stop you. But what I can tell you is the best investors are the ones that think independently. I'm not going to get everything right. In fact, Peter Lynch always says, you are a phenomenal investor if you're right 60% of the time. You're a legendary, one of the best of all time. My goal is to be right 40 to 50% of the time, and I will be Warren Buffett status, right? Mm-hmm. So I look at the numbers, I look at the cash flow, I go to the 8 pillars here, and you might look at the 8 pillars here and actually go like, hey, they've increased their shares outstanding. But the great news is their growth rate is huge.
Warren Buffett status?
Oh, yeah. Warren Buffett's 60%? Right at 40 to 50% of the time.
Yeah.
And he's had some big killers. Yeah, Warren Buffett isn't right 80, 90% of the time. No chance.
You're right. Keep going.
These growth rates are what I'm banking on. I'm not banking on, I'd cut these in half, and the stock still makes a ton of sense. So when I'm looking at Alibaba, I'm embracing bad news. Why? It's just like, pick the favorite thing in the world you like to buy. For the ladies out there, purses and shoes. For the guys out there, watches. I don't know what guys like. Watches, sporting events, whatever it is, sporting. Would you rather pay more or less for it? That's the whole idea behind it.
I think some of our viewers want to pay less for it and then have it go up tomorrow.
Great. That's not reality. So one thing, we're going to do another video, and you'll see it soon, about stock market crashes. Guys, you're caught in the middle, and where every single day, this stock price goes up and down. This is Mr. Market telling you what we think the stock is worth. You have to decide if you're a buyer or seller, or you're going to hold. That's it. Now, just remember, think back 20 years for those of you who are old enough, because a lot of our viewers are, sub 40. Most of our viewers are actually sub 40. But if you look at history, good companies that stuck around, they had big drops. I mean, look at Berkshire Hathaway. Munger and Buffett say Berkshire Hathaway stock has fallen in half 3 times since they've owned it. In half. And guess what? In 1970, Warren Buffett was buying a former partner of his shares for $40 a share. The stock is currently at $400,000 per share. Not $400 a share, $400,000 per share from $40.
Yeah, wow.
And it's fallen in half 3 times since. So guys, with Baba, I look at it as China's #1 company. Worldwide, it's doing great. We use Alibaba. We love it. Alipay is very big in China. You have China, the largest country in the world population-wise, and the fastest growing middle class. I'm just banking on that.
Baba pays in America too, Paul.
Yeah.
Alipay, yesterday, I think it was yesterday,
Alipay.
They just went over to CVS.
Really?
Alipay, yeah. So now you see on the thing, it's Apple Pay,
I think Baba could be one of my,
Alipay.
I'm going to hold this for decades thing. I look at this as another Amazon kind of company.
I guess in general, if a couple dollars, I tried to explain this to my buddy last night. It's like, why do we always want it to go up right after we buy it? Why do we want it to go down where most people want it to go up? And I'm thinking, well, we think it's valued at a higher position than it currently is.
Yes.
Our numbers, the style of our investing, we think it's a $600-700 stock moving forward in the next 7 years. So
no, I actually think it's $1,000 stock in 7 years.
So a few dollars today doesn't really matter for us when we think this. But the hilariousness about all this, Paul, is the hesitation with some folks is the uncertainty with the Chinese government regulating big businesses.
Guess what, guys? In the last 100 years, the stock market's up how much? In that time, we've had 2 world wars. We've had a Great Depression. We've had assassinations of how many presidents? We've had 9/11. We've had every single day there's a reason not to own something.
Yes.
That's why I take away all the noise and focus on very few fundamentals. I actually do a lot less research than most value investors. I focus on free cash flow, debt, and return on invested capital. And if I think the company's going to be around, I stick with it. That's the way I look at it. And guess what? I beat the market. Now, in the last 4 or 5 years, I haven't. Why? Because it's been very, very difficult to find companies that sell at those multiples I like. I'm okay with that. I'm 40. I care about 60 years from now.
Yeah.
I don't care about today. I care about 60 years from now. That's it. And I look at it saying it's a very hard, that's why investing in general is mentality. It's not knowledge of numbers. There's a lot of people who have knowledge of numbers and they don't have the mentality to be able to sit there and say, like Alibaba, when I first bought it, 184. It got to 138 the other day. Guess how much I cared? 0. In fact, I was like, man, should I buy some now or should I just sell puts, wait for those puts? And I was like, okay. And I regret not buying some, not because it went up now, because I'm worried, could this be the low ever? And that's what worries me.
Paul, I saw on Mo, you can react to this. I saw sort of a trolling comment. I think it might be the mindset of a lot of normal people out there. Is they said, boy, you guys on this show, you love Baba and hate Bitcoin. And now look, Baba's down another $50 and Bitcoin is soaring. And I was like, boy.
But it's funny because
recency bias.
It's recency bias. We are, like we just said, we are looking 5 to 7 to 10 years down the road. You're looking 5 to 7 to 10 days down the road. And we are going to do better than you because we have that ability to do that.
It's been proven time and time again. When you follow hype and exit when things are bad and follow hype when it's good, you end up doing poorly. If you follow the crowd, it's just proven. Guys, there's never been a study to not prove that. It's every single study done basically saying if you follow hype and if you exit when things look bad, you do worse, flat out. You absolutely do worse without a doubt.
And those same people that probably own that and are blaming us right now, they're going to be too scared to sell it because they don't want to sell at a loss because that's what hype people do. And then when it's way up and it's doing well in a couple of years, and they're not going to say anything to us. Even though
look at this,
we're
guys.
right about this conversation.
This is when Intel was most popular.
Perfect example.
This is when Intel was least popular. Which one do you want to buy at? And every investment in history is, this is when it's most popular, this is when it's least popular. It's your decision.
Yeah,
it's absolutely your decision. Because guess what, guys? These stock prices are dependent on how popular the stock is.
Yeah, if there was a YouTube, the volume of videos up there would be great. It's right. It's a 10xer. It's a banger. Get your oven mitts ready. And then down there, it's a dying, stupid company.
It's just the way it is. Now, the hard part is being down here and going, wait, is this really this bad of a stock? Guys, I've only ever once bought a stock at like a real big bottom. That was Microsoft. It was my first time going, okay, Paul, go look at the financials really hard and don't just follow. I was always very good about being in the market and putting more money in when the market was falling, but I didn't want to buy individual stocks until about 10 or 11 years ago, right? But Microsoft was one of my first ones because everybody told me I was wrong. All these tech CEOs were like, Paul, Microsoft is dead. You don't know what's going on here. It is a dead company. Oh, how dead is it now? Because I just looked at it and saying, it's a dead company that's growing revenue 8% a year and profit 11% a year. That's like saying, I just passed the physical. I ran a 40 in 4.4 seconds, and I'm dead. That just didn't make any sense to me. How can I grow revenue and profit while being dead as a company?
And Seth, it is difficult. I mean, you're getting way better at putting, but you still struggle, right?
Yeah, sure.
Yeah,
still learning.
But it's a learning curve, and if you want to do it, Seth is proof that you can do it if you want to do it and if you believe in it. So stick to it if you actually listen to us, and if you don't, I don't know.
Yeah, people laugh at me, Paul. I see some comments. People laugh because we did a show where I owned 140 shares of Tesla, about 80 shares of Amazon, and 3 Bitcoin, and we talked about how much money I would currently have.
Yeah, but I'm looking at going, you're going to retire at 65 or 70 because of this process. Yeah, even if you lost out on those, and you're going to have way more money than if you just. Sometimes the worst thing that can happen to you is is not following a process and end up looking right.
Yes, looking right. That's right.
That's one of the worst things that can happen to you. Right. You know, it's like, here's an analogy. You cheat on your wife, you get away with it. That's one of the worst things that can happen to you. Why? Oh, I'll get away with it next time and next time. And all of a sudden, before you know it, you're homeless, you're living in a car, and you're paying your wife $5,000 a month in child support while she bangs your best friend. I mean, you decide. You can decide all you want.
That went far quickly. I would say in general.
Too soon, Seth?
I always love to see how far it goes.
I would say in
general. I don't think that was that far.
It was just speedy. It was really quick. Yes. I mean, next thing you know, if you're out there and you're a 26-year-old investor, you have that invincible feeling and a bunch of old farts saying, this is the way I'm just finding, Paul, as I move on in life, Mo, and you're 30, by the time I'm hitting 40, the real people, and Tim and I were talking about this beforehand, the real people who are always kind of flying by the seat of their pants, sort of the fake it till you make it people, they do sputter out after a while. Their true colors finally come out. So if you're 27 and you just think you got the world in the palm of your hand, you're just the greatest investor, at some point, one of these big trades might cost you. Go ahead, Paul.
Psychology of money. If you're part of our software, we have a book club every Friday. Every other Friday. This Friday, we're discussing chapters 5, 6, and 7 of the Psychology of Money. In it, Warren Buffett and Charlie Munger had a third partner that I was talking about, the one he bought the shares from.
Yeah.
Warren Buffett said, Charlie and I always knew we were going to be very rich. We just weren't in a hurry. This guy was in a hurry. And because he was in a hurry, he made mistakes. He took on debt. And then all of a sudden, the crash of the early 70s happens. He had to liquidate in order to cover all of his debts. So he sold Warren Buffett his shares of Berkshire Hathaway for less than $40 per share.
Wow.
Guys, $40 per share. Please look at my screen right now. $422,000 is the stock price right now. If that guy didn't jump from a building after that, I mean, how do you live like this? He sold for, why? Because he wanted to be so rich so quickly. We all want to be rich quickly. It's what we see in the media and all this stuff. But at the end of the day, Warren and Charlie said, "Oh, we're going to be really rich. What's the rush?" Mm-hmm. It's just unbelievable to me. And by the way, by that point, I think Warren was worth probably $40 million then, which is probably $500 million today. So he had plenty of money. He was very rich, but he has $84 billion today. That's less than 1%. I mean, it's insane. So, guys, just follow the right process. It will work for you. Learn the process from us. Baba's an example. And by the way, we like Intel, Baba, Walgreens, Smith & Wesson. There's a lot of companies we like. Don't gauge anything based off one pick. Don't gauge it off of 1 month. Don't gauge it off 1 year. 10 years from now, we have 10 million subscribers. I want everybody going, man, I followed Paul and Mo and Seth when they had 20,000 subscribers, 80,000 subscribers, and I followed their process. And wow, yes, there were some that were wrong, but we did very well.
That's our take on Baba. That's our take on buying it and the mindset if it starts going down for all of your investments. Keep following us. Tons of videos. Follow the thumbs up. Join our community below at everythingmoney.com. And you can join some like-minded folks talking the same style. So anyway, that's our take. Follow, thumbs up. See you next time.